The question we're asking is what would happen to our investments if a series of extreme weather events were to cause supply chain disruptions and a global food supply shock. It really starts with these extreme weather events hitting two major food-producing regions, and that sets off crop failures. In addition, you have supply chain disruption, which causes lower growth and higher inflation. The first-order effects are quite intuitive. You have a supply shock, so as a result, global food prices increase. And at the same time, you have the supply chain disruption, which causes lower growth, and it pushes inflation even higher. Because of the higher inflation, you get higher yields, and that impacts bonds. So we estimate a 10% drop in our fixed income portfolio. At the same time, you have lower growth, and that weighs on equities and dividends. And together with higher yields, it causes a drop in 24% of our equities portfolio. When you put these two things together at the fund level, you get a 20% loss in value, and that's equal to $420 billion US. Like any other scenario, we look first at past events that might have similar characteristics to the ones we're interested in. In addition, we anchor on studies that model how events like these might impact the key variables in our modeling. Then we put these two things together, and once we define the shocks, we can apply them to our current portfolio, and that allows us to estimate the impacts to our portfolio. These scenarios are entirely hypothetical. What we're doing here is we're trying to understand how prepared we are if such scenarios were to happen. Of course, scenarios are much simpler than the real world, and most likely these scenarios will not happen in isolation. The point is that with this type of analysis, we prepare and think about how these risks are interconnected, and it allows us to quantify what the impact will be on the portfolio.